Welcome back to 15 Minutes of Finance. My name is Brandon West, a CPA, and I'm going to help you keep more of your money. Today's episode is about how taxes are paid and when taxes are due, because I would wager the majority of my listeners here don't actually know the answer of when taxes are due. I would bet that you don't. As a CPA with our own practice here, just wrapped up tax season, so just finished a lot of tax returns. I'm still a little tired. That's why I'm doing the Friday episode here, so that James could do the early week episode while I was in the midst of in the trenches of tax season, getting ready for that deadline. So head's a little clearer now. Got a day or two off, slept in, and now I'm ready to talk about taxes without twitching and having PTSD episodes from the last couple days. So let's talk about taxes. So this is a big misconception that I saw with my clients. And so I figured, well, if a lot of my clients didn't understand this before working with me, probably a lot of our listeners don't. Okay. So I'm going to ask you this question. I'm going to give you a couple seconds to think about it. It's not a trick question. And I want to think of what your answer is. Okay. So think about your answer to this question before I tell you the answer. When are taxes due every year? That's the question. It's not a trick question. Now, if you're like a lot of my clients, if you're like a lot of our, I'm sure, listeners, people I talk to day to day, what's your answer? April 15th. That's tax day, right? That's when you pay your taxes. That's when you get a refund. That is not when taxes are due, everybody. A lot of people are wage earners at a job. Okay, so you aren't actively thinking about payroll and payroll timeline and management and tax payments, right? You're getting taxes automatically withheld magically, right? From your W-2, you fill out that W-4 form when you get hired, and some magical formulas happen and you get your net paycheck every month and you go, cool, that's how much money I have, right? And for a lot of you, you expect a refund at tax season. Some people, you're right on the line, or maybe you owe a couple $100 every year. And that's how you go about tax time, right? You do your taxes, deadline is April 15th. So what you might not realize, and what is the law applicable to all taxpayers, is taxes are being paid and taxes are due every quarter. Okay. And it's not even exact perfect quarters. That would be even easier. No. It's a little weird even for when the quarterly payments are due. Okay. So when taxes are due every year, they are due quarterly, and those payment dates are April 15th, June 15th, September 15th, and January 15th. So if you don't know this, when you work a job and you have a W-2, your employer is paying those taxes to the IRS quarterly based on those dates on your behalf. You are paying taxes quarterly. You're not paying on April 15th. You just don't realize that those withholdings from each paycheck, oftentimes weekly or bi-weekly, are being paid to the IRS quarterly, okay? Or even monthly. There's different employment rules when you become a big employer and things like that. But you're paying taxes throughout the year. So why is this a big shock? Why am I talking about this? Well, for a lot of clients in all sorts of situations, right? This could be you have a large amount of interest because with the stock market volatile and with high yield savings accounts earning higher interest, you've put a lot of your money into high yield savings accounts and you've got $10,000 in interest that you don't usually have. You might have made large capital gains in 2023, 2024, these great years for the stock market, right? Maybe you liquidated some of those gains while things were up and you have a much larger capital gain than you usually do. You might have a business venture. That's a lot of our clients. I'm sort of a small business specialist, I would say, is a big makeup of our firm, is working with entrepreneurs and business owners. For those business owners, you're earning money throughout the year. You have your side hustle. Maybe you have a full-on side business that you do full-time. You just work for yourself. All of those situations mean that you have taxable income, and when you get to April 15th and you haven't factored in that income at all, and on your W-2 job withholdings, you've only been considering your wages from that one job, but your income is much higher than just your job, and you under withheld taxes quarterly throughout the year, you're going to have an underpayment penalty from the IRS. Okay, so a lot of people think, oh, I paid April 15th. Why do I have a penalty? And that's a lot of new clients that I get when I try to explain this. We try to improve things for the next year, but a lot of new clients came into our firm this year. Some of them had underpayment penalties and no one explained to them before, hey, there are multiple penalties that you could potentially incur. There's failure to pay, failure to file penalties, right? You don't file your taxes. You don't do your extension in time. You don't pay your taxes that are due still by April 15th, right? You're going to get penalized from that. But there's also underpayment penalties by not paying enough each quarter that are going to hit you with penalties, okay? And they're not massively substantial, right? If you have $3,000 owed, you're not going to owe $1,000 in penalties, but it could be $50, okay? I'm not going to break down the formula because it's based on how much you underpaid per quarter and all that stuff. So I'm not going to break down how it's calculated, but it can be a couple percent. And if your taxes owed are $80,000, okay, you have like you're a business owner who makes significant income and you don't withhold any estimated taxes throughout the year. Now your underpayment penalty could be several $1,000s, okay, because it's only a couple percent, but your tax bill is almost $100,000. So the more you make, the more significant it is, but everyone has to pay taxes quarterly. And if you do only have a W-2 job, that's all you make, you don't really have to worry about this because your employer is automatically withholding things from your paycheck. You're good. You're fine. You don't have to worry about this, okay? But for anybody that has any type of income that is not having taxes automatically, quarterly withheld from it, this is an important concept to understand so that you don't get hit with underpayment penalties when you file your taxes each year, okay? All right. Going to take a quick break before we talk about how to avoid this problem, and we're going to talk about our next tax profile, all right? This is our new segment where we highlight a way that we helped a client this tax year that might be applicable to you. Maybe it helps you understand write-offs that you can take advantage of. This client is someone in real estate, okay? So they're a real estate professional. For a long time, they've worked for a firm as one of their real estate agents. They got their own license. They've started to break out on their own, okay? So now they work for themselves as a self-employed real estate professional, okay? This person sends me all of their documents. I enter their income, expenses. They owe roughly $9,500 in taxes plus some extra taxes to the state that they're in, okay? Not a great email. So what I always do is I send that email to my clients. I want them to know, based on how much you earned, this is how much you're going to owe. Now, let's go through some questions. Let's go through some checklists. Let's tax plan and strategize with you to make sure we're maximizing your situation. But based on the information you provided to me, I always tell my clients, this is how much it would be. Now let's try to make it better, right? And then they understand the importance of tax planning. And I'll be completely honest and transparent, it makes me look really good that they're actually paying a CPA for something, because now they can see this is what it would have been if you just entered this, these numbers into TurboTax or whatever. Now let's actually look into how we can tax plan, and then it helps kind of legitimize what I do and why are they even working with a CPA. So I'll be completely honest, there is a little bit of a selfish reason that I do this, but I do think it really helps with understanding the process of tax planning. So the two big things that this person was able to take advantage of were vehicle deductions and home office deductions. Okay, we talked a little bit last week about home office deductions and some ways that we optimized the way that home office was taken. So this individual didn't realize that she could write off one of their rooms as a home office. Okay, and this was a legitimate home office. They live by themselves. They've got 2 bedrooms. One room is an office with desk, computer, printer. It is literally just a workroom. That counts. That is a home office that this person works out of. So now, as we've talked about, the percentage of their square footage of the home office versus the square footage of the entire home, that percentage, we can now take all of those home expenses and write off that percentage of those expenses. That was significant. The even more significant thing for this taxpayer is now they were doing all of this driving to shows, to do open houses and showings and all of the things that goes into real estate planning. And so they bought a new vehicle to use for work. And they have another personal vehicle, but this is their work vehicle. As a self-employed individual driving to numerous job sites, that's a legitimate business vehicle used for business purposes. So now we had to come up with a way to allocate business versus personal usage of this vehicle, but this was largely, almost all of the miles were for business, so this was a business vehicle. And what she had done is she had substantiated not home office deductions, mileage deductions. So the IRS allows you to write off a percentage deduction of every business mile you drove. And for self-employed individuals in 2024, that's 67 cents per mile. Okay, so if you drove 1,000 miles for the year, you'd get a $670 deduction to offset income, okay? But what this taxpayer hadn't planned on was there are two methods of deducting vehicle expenses for self-employed individuals. There's the mileage rate, and then there's also the actual expense method. So we use the actual expense method because this was a new car purchased in 2024, and the actual expense method allowed us to take not only the actual cost of repairs, gas, all of the actual costs that go into the car, but also a depreciation deduction of the cost of the car. And there's something called bonus depreciation that allows you to take a certain amount accelerated in the first year. And for that, 2020, for 2024, the bonus depreciation for cars under 6,000 pounds was $20,400. So now we went from a couple $1,000s in mileage deductions to a $20,000 deduction. Then we added in the home office, and the tax bill went from about $9,500 to less than $1,000. That was a great email I got to send. I don't always get to send that good of an email, no matter how good your CPA is. There's only so much planning that can adjust the actual truth of the matter, right? If you didn't buy a new car, I can't get you depreciation, right? So this taxpayer unknowingly really had put themselves in a good position to get these deductions. They had very legitimate books and records, clear records of all of their expenses. It was easy to substantiate these two things on the tax return, and it made an almost five-figure $10,000 difference on their taxes this year. So that's a really great way that shows the combination of vehicle expenses, choosing between two methods, and working to optimize which method works for you, as well as the home office deduction made a huge impact on this client's tax season. It was able for me to offer great news, and luckily we were able to lower this client's taxes by a lot. Major win for this tax season. So those stories always make tax season a lot more fun than kind of the piles of W-2 tax returns where I kind of just feel like a robot entering information for people with very, very little planning that goes into it. So it's always cool to have those type of clients that you can really plan with, and then also now plan for the future, things like estimated payments. Make sure that next year they're not surprised with the tax bill, as it probably will be higher next year. We're not going to be able to write off $20,000 of vehicle deduction every year, right? So there's a reality of successful business ownership. Eventually it comes with tax bills usually, and now we can plan for it very effectively as a year-to-year client of ours. Let's jump back into it. How do you avoid the underpayment penalties? Because you should be paying taxes quarterly, okay? Now there's another method to do this, and that's just the actual payment method. And the IRS says that if you pay 90% of what you actually owe, there's no underpayment penalty. So even if you owe a little bit at tax time, if you had paid quarterly and on time at least 90%, you're good. It's called a safe harbor election, okay? So a safe harbor meaning as long as you do this, you're within that safe harbor, you're protected. You didn't do it exactly right, but you got to 90%, so there's no penalty. You just have to pay us the remaining amount owed by April 15th, okay? You might be wondering, well, how am I supposed to pay you 90% of what I owe? I don't know how much I owe until I do my taxes at tax time, right? So what people who are in this new quarterly planning process don't realize is that successful people have to do quarterly tax planning. That means usually working with their CPA, but you can also do it individually. Every year, there's easier and easier tax planning tools as technology gets better. There's lots of free online tax calculators where you can say, this is how much I've earned so far. This is how much I think I'm going to make. You know, I'm single or married. I have this many kids or no kids. It'll calculate how much it owes, and then you can figure out 1/4 of that is what you should pay, each quarter in taxes. So there are tax planning tools online. If you don't want to do this, or you're just in a situation where it's not worth your time, you don't make a lot of money, so it's not really worth paying for a CPA's time to do these quarterly estimates for you, there's another method that's more utilized by taxpayers. A lot more taxpayers use this method, okay? And this is the other element of the safe harbor election. So to avoid underpayment, you can either actually calculate and make sure that you paid at least 90% of what you actually owe, or you can pay at least 100% of what you owed last year. Okay, so if you have the same job and last year, because of your side income and your investments, you owed $8,000, okay, you should be making quarterly estimated payments of $2,000 each quarter so that when you get to the end of the year, you've pretty much paid everything, right? You know that you've at least paid 100% of last year's tax bill, so you're good, okay? It doesn't mean you don't owe. Maybe your business exploded this year. Maybe you're way more successful than last year. But this safe harbor means that you don't have to constantly tax plan throughout each quarter to make sure that you're tracking, your business growth and paying exactly how much you owe. You can just say, look, if I grow, I'm going to set aside some money. I'm planning on owing some at tax time, but I'm not going to have any penalties because I've qualified for the safe harbor and I've paid at least 100% of what I owed last year. So if I owe more this year and I made more money, awesome. I was more successful this year. I'm not going to get penalized for that because I've qualified for the safe harbor and I paid what I owed last year. So those are the two methods. If your income comes from anywhere that isn't something like just a job, a W-2 that's automatically withholding taxes for you on a quarterly basis, those are the methods you can use to pay quarterly and avoid underpayment penalties. So there's a fun fact for you guys today. Taxes are not due April 15th. Tax day to file and to pay any remaining taxes is due on April 15th. Okay, so you can't have any remaining tax bills after April 15th without getting penalized. You'll have a failure to pay penalty, and each month that you don't pay, it'll keep increasing. So you have to pay anything remaining by April 15th, but taxes are not due April 15th. They are due quarterly, and you need to be paying quarterly if you have non-automatically withheld sources of income so that you don't get to tax time and not only have maybe a failure to pay penalty, but an underpayment penalty for not paying enough each quarter throughout the year. And that's just extra money now you have to pay the IRS above and beyond what you already owe in taxes. And I know from working with quite a few clients that I don't have a lot of clients that I know that enjoy that conversation of, hey, you owe extra in penalties to the IRS. That's never a fun conversation to have, and you should be avoiding it as much as possible because it's your money and you should keep it. All right, that is another episode of 15 Minutes of Finance. Thank you so much for tuning in again. As always, share this with your friends and family. I don't think there's really anybody who can't benefit from this episode. Very few people understand that taxes are not due April 15th. It's a fun fact check, and I was generally on time, right? If you don't count this little intro and the amount that I'm talking now, the content was pretty much in 15 minutes, all right? I'm pretty proud of myself. I know it's almost a joke now, 15 minutes of finance, because James and I love what we do, and we almost always talk more than 15 minutes. But, we were pretty good this time. So it's a pretty quick listen to give someone some knowledge and make sure they're on track to not owe estimated tax payments, because we don't want to pay the IRS any more than we have to. That's my goal as a CPA for all of my clients and for all of my listeners as well. So send this along to someone who could benefit from it. And as always, leave a comment. You can reach out to us directly. Send us a message about something you'd like to hear covered on Spotify. You can leave comments directly on the video, leave questions, and we will answer them in future episodes. And as always, invest early, invest often, and we'll see you next time.